I thought we'd start with your background just to introduce you to the listeners. I've got a question here based on what you studied at university or college. I read you earned your BS degree in finance and value investing from Fordham University, New York. So I'm keen to understand how, and if it does at all, sort of how that informs your approach to investment analysis now at GlobalX.
Yeah, I would say it's more relevant for me in terms of individual interest and sort of I'm trying to understand or do any of the security analysis that helps me get a better grip of a theme. It's not so relevant to the overall thematic approach because a lot of the themes we're covering, robotics, artificial intelligence, renewable energy, these are industries very much in their early stages, and companies are, in most cases looking to build out revenue, market share, trying to get their business models off the ground. So profitability and valuations in many cases come later.
I assumed from an outsider looking in, it would be difficult to balance those more kind of fundamental based style analyses, looking at the value of a business versus these growth-oriented opportunities that obviously GlobalX focuses on. So, just interested to hear you touch on that. But I think let's use that as a junction then to move into the subject of today's interview. I want to start with climate change. We won't spend too long on that, but I think it's a useful kind of mega trend from which to open up the conversation. And then we'll dig into a few thematic opportunities that are coming off the back of that trend. And I guess another reason to focus on it is simply because it's the most prescient megatrend of our time.
Sure.
I think it's fair to say we saw the hottest month on record in July, the hottest ever September just last month. So now more than ever, the world is in need of technologies to battle the threat of the climate crisis. But to start, in your view, does the current regulatory landscape support the 1.5 degrees target, widely quoted as the desired maximum for planetary warming? How do you sort of feel about that? What's GlobalX's take on that?
Yeah, so it varies. I think that there are, a lot of technologies that have come a long way. And some of this is because of developing supply chains and accommodative government policy, as well as just improvements to that underlying technology. But, if we look across the clean tech space, I think the overwhelming opinion is that a lot of these technologies need to be adopted quicker to actually reach that, that threshold. And for some more color there, that 1.5 degrees Celsius target would require us to reach net zero emissions by 2050. And that's a big part of this investment case for a lot of these clean tech companies is we still have the time and the agency to actually chip away at emissions and to, reach our climate goals so we're not facing intensifying climate externalities. So, a lot of these technologies have a long way to go, but there are some incredible bright spots in terms of technologies that are actually on pace to reach that threshold for 1.5 degrees Celsius. For instance, electric vehicles and solar PV for electricity generation. These are categories that the International Energy Agency has actually highlighted as growing on pace with what we need, which is frankly incredible. So, long story short, if we look across the space, there are certainly a lot of technologies that need more progress. But what we've seen from those technologies is very encouraging, especially on the electric vehicle, the solar front as well.
Yeah, interesting. So to touch on solar investment then, it seems to be setting the pace in terms of US clean tech spend with the lion's share of new projects since the IRA announcement commencing in the solar manufacturing space. So is increased solar energy production our best chance of reducing greenhouse gases? Do you think, do GlobalX have a view on that?
Yeah, it's a great question. I think the short answer to the question is it's not a one size fits all. And the Inflation Reduction Act has been a huge game changer. It directs, it's about $370 billion in climate-related tax credits and incentives to really change the calculus for, what role the United States is playing in this clean tech story broadly. So that's been a game changer, and happy to dive into that later as well. But I think some of the reason that you're seeing solar take the lion's share here is quite simple. It's cheaper. Solar electricity is some of the cheapest electricity you can put on a grid. In most markets around the world, it's competitive with fossil fuels. Even though wind energy is also getting to the point where it's cost competitive with fossil fuel, it's not quite as inexpensive as solar, generally speaking. There's also this aspect, especially in the United States, of distributed energy generation, the fact that you can install panels on top of rooftops. This is easier for a lot of consumers are trying to seek refuge from rising energy costs, and it's a lot easier to install a solar panel than to necessarily tap into a wind turbine or a turbine farm for the consumer. So those are some of the reasons you've seen solar be such a fast growing industry and a larger portion of those Inflation Reduction Act investments so far. I will say though that moving forward, like I said, it's not a one-size-fits-all approach. Right now, every country has an energy mix. Some countries are more reliant on nuclear or oil or gas, and more recently renewables. And we'd expect, certain markets are highly favorable for solar. Some markets are, there's a much different generation profile for wind, so that could be more ideal in other markets. And then sometimes you would definitely need energy storage options to justify using solar in certain markets. So, we have a lot of conviction in a lot of these technologies moving forward. But in the near term, we certainly have seen, solar be a winner partially because of cost dynamics.
Yeah. Okay. Got it. And to move away from clean tech explicitly, then I want to talk about a few other themes that are impacted by that megatrend that we set out at the top of the show. So, the first of those, I think, is lithium. According to the IEA, demand from the renewable energy sector, so I guess there's the link back, was the main factor behind a tripling in overall demand for lithium from 2017 to last year. So, how important, because I'm keen now to focus on the regions that are driving this growth and impacting that market more specifically, how important is Latin America's contribution to global lithium production?
Yeah, it's very important. But for some context here too, certainly renewables has factored into the growth in the lithium demand from an energy storage perspective. The biggest driver has been electric vehicles, and that's another technology that is vital for chipping away at emissions from the roads, right? So, and EVs have been such a big change for the industry because in many cases you're literally using tens of thousands of times more lithium in terms of kilograms used in an electric vehicle versus your consumer electronics, which were traditionally where a lot of demand for lithium actually came from. So that's been a big game changer. Renewables has been a game changer, but in terms of Latin America, it's quite important. About a third of the world's lithium comes from what's called the South America Lithium Triangle, which is a bit misleading, and we can get into that a little bit. And I say it's misleading because it's sort of disproportionate in terms of where production comes from. That lithium triangle is Chile, Argentina, and Bolivia, but it's really Chile that is accounting for the vast majority of this production. It's Chile is the second largest lithium producer behind Australia. It produces around 30%, give or take, of our lithium. Next comes Argentina, produces about 5%. So, much smaller market compared to Chile. And then Bolivia, even though that country has some of the world's largest reserves, for regulatory reasons, for meteorological reasons, you barely see any production yet coming out of Bolivia. But right now, very large market for lithium, and moving forward, certainly a lot of projects in the pipeline. Certainly could be important too from the standpoint we were talking about the Inflation Reduction Act, the aspect that the United States is trying to build out these incentives for either domestic sourcing of materials or sourcing from trading partners, which Chile is an important trading partner that's sort of baked into the Inflation Reduction Act. So we'd expect Latin America to continue to be very important moving forward for the lithium space.
Got it. Okay, so we've already sort of set out that Chile's lithium is crucial both to renewable energy, as I mentioned, but more importantly to the growth of EV production and adoption, as you mentioned. So, how credible then is the threat of lithium nationalization in the region? And before we go into the credibility of the threat, perhaps you can talk us through what's happening there in relation to government intervention.
Sure. Yeah, absolutely. Yeah. So this really came to a forefront in April of this year, when Chilean President Gabriel Boric followed through on a campaign promise. And this promise was to instill greater government control over the lithium industry. And the reasoning being here is that it's a fast-growing industry. It's economically vital. As you mentioned, this access is important to the world. So very much there's an incentive to gain control there, and also from sort of an environmental regulatory standpoint, the government wants a higher degree of control. So the policy, the framework here is that moving forward, new and existing projects in Chile that are operating must hand over at least 51% ownership to the Chilean government. So, on the surface, a seismic shift. There is nuance here, though. It's not the traditional nationalization in that the government is coming in immediately and taking over projects and taking over assets. The government has asserted that it will respect pre-existing contracts, and that really comes into play for two major miners, SQM and Albemarle. SQM being a Chilean resource company, and Albemarle being domiciled in the United States but having lithium operations around the world, which are the two main operators in the region right now. But they do have contracts. Albemarle has a contract through 2030, through 2043, whereas SQM has a contract through 2030. And happy to dive into what that means for these companies exactly, but in terms of immediate state control, we're not likely to see that.
Okay, got it. Yeah, I mean, my next question was to dive into what that means practically for those two businesses, just because I think a lot of listeners will either be invested in them or have heard of them and potentially thinking about that.
Yeah, absolutely. So for Albemarle, it's a very different story for both of these companies. So as mentioned, Albemarle has a contract that will last for another 20 years. So in our view, there's likely very minimal impact from this. And in the words of management for Albemarle, there's likely to be no material impact on the business model. So, Albemarle seems fairly insulated from this, mechanism. SQM is a different story because, as mentioned, that contract is 2030, certainly several years left, but that becomes more of an existential type of idea. If you're not able to come to some agreement with the government, you're not going to be able to operate. So that's what they're doing. SQM has come to the negotiating table with the Chilean government. And that really started in May of this year, and we haven't seen much of an update yet. It's likely that we'll get a little bit more clarity by the end of the year, exactly what's going to transpire. I think the thinking in the industry is that what does come to pass is likely to be favorable to SQM, at least as favorable as possible when you're talking about more government control over a project, because SQM is one of the economic crown jewels for the country, and certainly it's the success of the Chilean lithium industry is largely predicated on what SQM is able to do moving forward. And then the other aspect here too is this policy is subject to change politically. We could see a completely new administration come in 2025. So if SQM is coming to the negotiating table before it has to, and likely this is to, get the best possible arrangement out of it. But at the end of the day, if the company doesn't see, a policy or a path forward that's favorable for shareholders, they could bide their time until 2025, see how that shakes out, and then go from there. If they have to come back to the negotiating table, they can. But again, very different story. Albemarle nearly unaffected. SQM will be affected, but in a way that we think will be as favorable as possible.
Got it. And if we're thinking about the kind of lithium investment opportunity as a whole, I imagine there are other parts of the production value chain that investors can think about. We've spoken about the miners specifically, but talk to me about the other areas that investors could look at. Yeah,
thank you for asking that. That's I think at Global X we have a pretty differentiated approach in terms of how we think about this value chain. We really think about lithium and electric vehicles as you might think about the traditional energy space, with a upstream, midstream, and downstream component. In our view, the upstream is, as we mentioned, the lithium miners actually extracting this material from the ground, and that's, as we mentioned, SQM, Albemarle. More junior players like TNC, Alchem, Livent are also players in that space. You certainly also have this processing component as well. The actual, you have to convert that raw material into a battery grade resource. And many of these companies are integrated. Many of the miners have that conversion capacity. On the battery tech side, you have some conversion capacity as well. A great example is Ganfeng, which is one of the world's largest lithium miners, but it also has a tremendous amount of lithium refining capacity as well. And then if we move, that sort of those constituents are what we think of as the upstream. If we're thinking about the midstream, we're getting into the battery manufacturing, whether that's the separate components of a battery, the cathode, the anode, the separator, or if that's wrapping all of those components up into one lithium ion cell that's ultimately put into an electric vehicle or an energy storage option. And that market's fairly concentrated at the top. You have companies like Contemporary Amperex Technologies, or CATL. It's a Chinese battery maker that controls almost 35% of the global electric vehicle battery market. From there, you also have BYD, which listeners might know about from electric vehicle production, but the company is also the world's second largest battery maker for other electric vehicles outside of the BYD brand. A remarkable company. It also makes its own semiconductors, so pretty interesting one. LG Energy Solution is another major. It's a Korean battery maker. That's the third largest. And then beyond those sort of dedicated EV battery producers, you also have some traditional names. Panasonic, Samsung SDI. They account for, I believe it's around 7 to 5% respectively of the global EV battery market. And that's really how we're thinking about that theme. We think about lithium and battery tech, the upstream and midstream behind the electric vehicle revolution. We think of that as one theme, and we think of the electric vehicles as the downstream force that's pulling demand through the value chain, and we think that's sort of its own distinct theme.
Yeah, got it. No, I think that energy sector sort of comparison or framework's a really useful one, and not one that I'd heard before, so thank you for that. Just to finish off this conversation on lithium before we move on to our next theme then, I started by talking about sort of regional dispersion or distribution. We spoke about the triangle. That has since potentially grown to include Brazil and therefore make the triangle a quad. And with the nationalization narrative going on in Chile, to what extent do you think their dominance will be threatened by these new entrants or even some of those historic rivals?
Yeah, I think things are going to change. I think that this component of the value chain, the South American lithium mining, is one of the parts that's most prone to, I think, shift in who the major market players are. So, and the big reason we're seeing this is from the regulatory environment. Is certainly there is a project pipeline in Chile, but there is a high degree of government regulation, which certain operators feel comfortable with that type of environment and some don't. But ultimately, compared to Argentina or Brazil, as you mentioned, that have a much more aggressive policy framework in terms of trying to build out the lithium industry, you're likely to see Chile grow much slower than some of these markets, to the extent that you're likely to see Argentina become a larger supplier of lithium by 2030, which is a seismic shift from. And to recap, right now Chile produces 30%. Argentina produces 5% of global lithium, and Argentina is likely to grow quite quickly in the future. Brazil's an interesting one. Brazil's also going to be a fast-growing area, albeit from a smaller base. And there is a bit of a limitation there. For context, Argentina contains around 21% of the world's known lithium resources. Chile contains around 11%. Brazil contains less than 1%. So, and take those numbers with a grain of salt. Those identified resources aren't necessarily extraction ready or economical or anything, but you definitely will see more growth from Brazil, likely led by Sigma Lithium, which is a junior miner that actually just began production this year. But you could expect Sigma Lithium to account for most of that market moving forward. But we would look at Argentina and Brazil as the quicker growing components of the Latin America lithium market.
Great. Yeah, fantastic insights. And that part of the discussion on then. I want to move us on to our next theme, which is infrastructure, another theme obviously affected by the climate change megatrend that I set out at the top of the call. The IRA, we've already mentioned that piece of regulation and policy is the largest climate investment in US history, designed to mobilize capital to achieve the country's climate goals, according to the Wikipedia entry. So perhaps you can just explain how this legislation presents a compelling sort of investment opportunity in relation to the infrastructure theme. Can you join those two things together for us?
Yeah, it's an interesting one. And certainly, it's part of this aggressive federal agenda we've seen in recent years in terms of spending more on infrastructure. It's not as direct of an investment as something like an Infrastructure Investment and Jobs Act, which we'd be happy to talk about. But what the Inflation Reduction Act does is it provides all these credits and incentives to not only build out renewable energy production capacity, which is, these are capital intensive projects that will, require efforts from construction companies, but it's also about the manufacturing aspect. And to the extent that the bill, attempts to build out supply chains for these disruptive technologies like renewables and electric vehicles and batteries, these are, huge industrial complexes that, we simply need companies to come in and build that out. So from that standpoint, the manufacturing in the United States, that's where a lot of the opportunity comes from for the infrastructure theme. So again, not nearly as direct of an investment as the Infrastructure Investment and Jobs Act, but certainly there are powerful indirect benefits here.
Yeah. Okay. Well, let's move on to the more direct regulation that's having an impact on this then, and that comes in the form of the IIJA, the CHIPS Act as well. All of these pieces of regulation seem to be converging with the IRA to represent a significant tailwind for the infrastructure theme and spending in that industry. So has GlobalX quantified that opportunity at all? Give us a sense of the size of the theme.
Yeah, it's a huge opportunity. So to put some numbers there, the Infrastructure Investment and Jobs Act is, you'll hear these numbers get thrown around a little bit. It's a $1.2 trillion bill. That's the total cost, and it directs $550 billion in new spending. So to crystallize that a little bit, a significant portion of that bill is being spent on pre-existing programs or projects, or programs that needed to be funded, over the course of the next decade. And then that $550 billion, which we think is just this generational investment, is completely new. Is that marginal spending in infrastructure. For context too, the last major federal investment in infrastructure we saw was a component of the American Reinvestment and Recovery Act in 2009 that directed only $50 billion to the Department of Transportation to try to stimulate construction demand. So, historically, this bill stacks up against, some of the most major federal investments of all time. In terms of what that's looked like for opportunity, already around $280 billion from that fund is available at the state level. And that's being directed towards 38,000 projects already. Now, I don't want to mislead by what that number means necessarily. That's not 38,000 shovel-ready projects. I'm based in Manhattan. I'm not seeing, new railroads and bridges manifest. Unfortunately, we certainly need it. But in many cases, these projects are in their planning stages, and they are a very good indicator in our mind of where that federally funded construction work will occur. And the best news for construction companies and companies in the space is it's likely a small subset of what is to come from the bill. And I think it's also worth noting that it's been so powerful in terms of boosting funding for different federal programs. So, for instance, Amtrak, which is a operator of railroads in the country, they're going to be able to boost their annual capital investments from $2 billion in 2023 to about $6 billion in 2025, which is entirely from this bill. So just, obviously case by case, wide variance in terms of how much boosting and funding is coming from this bill for different federal programs, but it's been quite powerful. And then, I think it's worth mentioning too, the CHIPS Act, which was passed at the same time as actually the Inflation Reduction Act in August 2022. And that, that bill provides a smaller amount of funding, about a little bit more than 50 billion for directly building out semiconductor manufacturing in the United States. But it's the same sort of idea as the Inflation Reduction Act in terms of bringing that manufacturing here.
Yeah, got it. And maybe a bit of a tangent here, but I'm keen to understand whether this legislation reflects a broader trend of the US reshoring of manufacturing, supply chains, etc., and potentially whether that's actually an interesting investment opportunity or theme that listeners could watch out for.
Yeah, no, that's one of the major trends that we're highlighting right now. Certainly the bills and certainly the Infrastructure Investment Jobs Act is one of those key pillars that's galvanized sentiment toward this space. But this manufacturing reshoring story, we think, is already a multi-year trend. Mm-hmm. And it very much began with the pandemic in the early 2020. And frankly, I think a lot of vulnerabilities in supply chains, globalized supply chains, were exposed, and this prompted companies in the United States and around the world to rethink how their supply chains are oriented. And it's really not just a talking point for shareholders either, because we have seen enough time elapse between the beginning of the pandemic for a lot of these projects to actually break ground. And that's being reflected in construction starts and construction spending on U.S. manufacturing capacity. And you've actually seen construction spending on manufacturing far outpace other segments of the industry. It's grown about 2.5 times since the beginning of the pandemic. So very much, and this is a story that's also been exacerbated by the Russia-Ukraine crisis as well. Another sort of black swan that has exposed these supply chains. But certainly the bills and all their incentives to bring manufacturing to the United States, they only add fuel to the fire. And to that end, and I think this also goes into quantifying the opportunity here, is there's a private funding multiplier too. There's this idea that federal funding, it goes so far. In many cases, it provides enough of a discount on these projects that they're able to move forward, but it's also attracting, like I said, a huge amount of private funding. Since passage of the Inflation Reduction Act and the CHIPS Act, again, both in August 2022, you've seen about $480 billion in private investments flow into the United States for this manufacturing of those categories. The electric vehicles, the renewable energy, and actually the largest category there is semiconductors. So very much part of a longer term trend, but these bills have, only added momentum there.
Yeah, fantastic. And before we move on to understand, I suppose, how GlobalX capture the opportunities that we've talked about today, just on infrastructure, it's a wide theme, at least in my mind. It's about as broad as they get. So perhaps you can identify the different themes or sub-themes or even segments within this wider trend and point out the ones I suppose GlobalX feel are particularly compelling.
Sure. Yeah, that's really an exercise we do a lot here with thematics, and I'll be happy to dive into that deeper. Is sort of, it's great to say, we want pure play exposure to a theme or to an idea, but you really do have to articulate, what activities, what companies are actually playing out here, and it's not a traditional industry classification. I mean, I can tell you that, the opportunities we have in the space are very industrials, materials focused, but that's not enough. We've really identified 4 buckets, which we think constitute this value chain for U.S. infrastructure that stand to benefit from building out of these new assets across the country. The first one being the construction engineering firms. These are the AECOMs, the Jacobs Solutions, the Tutor Perinis of the world, the companies that are actually called in to do the design work, to execute on those designs, to operate construction projects. So that's really the first sort of line of demand there. Once you see sort of a stimulation in new construction spending, and then it flows down the value chain to 2 separate buckets. And we think one of them being raw materials and composites. That's steel, cement, aggregates, asphalt, any of these building blocks that we need to actually, bring these projects to fruition. And then similarly, you also have to look, the third bucket there is equipment. And that's a pretty wide-ranging bucket in its own right, but that's covering anything from heavy-duty machinery, cranes and so on and so forth, to picks and shovels. So any of that equipment that you need to build these projects. And then the last category there is what we call industrial or heavy transportation, which is heavy rail. And in many cases, rail is the only way to get, or the most efficient way to get these raw materials or these large quantities of equipment from, point A to point B to the construction site. So those are really sort of the activities that we've identified as, that value chain for U.S. infrastructure.
Got it. Yeah, fascinating. I wanted to give people a less abstract, I suppose, look at what this theme comprises. But to finish on a more general point then, I mentioned that I wanted to talk about how GlobalX capture these opportunities, and we've discussed several themes today already, but how do you go about capturing the potential of these opportunities, more importantly, within your thematic funds? And how do you go about identifying the stocks that you believe best represent each of those themes, for instance? Talk to us about the methodology.
It's ultimately a top-down, bottoms-up approach.
Yeah,
we're first looking to identify these disruptive trends, these themes that we think are going to, frankly, change the way we think about traditional industry, traditional segments, whether that's in with demographics or climate change, which we talked about, or technologies. We're looking for these one-time paradigm shifts where once adoption happens, we're not likely to, return to the mean or anything like that. We're very likely to see those technologies continue moving onwards. So and typically speaking, and actually I mentioned U.S. infrastructure today, and we talked about it. That's an exception to what we normally do. We're normally traditionally sector agnostic. We're normally geographically agnostic. We're not, checking where these companies are domiciled before, we're putting them. The exception is U.S. infrastructure, which, we have conviction in that market. specifically. But, there's three pillars to, trying to bring a product to market and then identifying these companies. The first has to be conviction. We certainly have to have a high degree of confidence that these trends are going to come to pass and they're going to come to, like I said, disrupt our traditional industries. But that's not enough. You certainly also need a degree of investability. There's certainly some themes that sound nice or, they sound very interesting, but we're not necessarily at the point where there's enough publicly traded companies with sufficient liquidity and also providing direct exposure to those themes to actually bring an ETF or a UCITS product to market. At minimum, we're looking for 20 to 25 companies that offer pure play exposure. In many cases, we're looking for more companies. But that's that key exercise that we actually sort of, went through last question is, what is our theme and what are these activities that actually constitute? And then from there, often, applying those, minimum requirements in terms of liquidity and some other factors. But the main idea there is pure play exposure to one of those subcategories within the theme. And then the last component there, that's really about identifying securities. But in terms of a broader theme, we're very much looking at time frame. Is this a theme that's going to play out over, a year or two? Is it going to be a momentum sort of cyclical play, or is it going to be a 10, 15 year or several decade theme? And in most cases, we very much are looking at those themes that are going to take longer than a decade. In most cases, we're talking about renewables, we're talking about electric vehicles, we're talking about hydrogen. We're talking decades here. So that long-term time horizon is also very important for us.
Yeah, fantastic. And before we close then, you referenced pure play a couple of times. It's something that we speak about a lot internally as well. But I think people have different definitions of what it means to be a pure play business. So talk to me about Global X's definition.
Sure. It's, simply it's 50% or more revenue from one of these categories, one of these sub-themes. There are some exceptions. We're trying to provide as much pure play exposure as possible. But in some cases, in industry or important industry players, a great example here is we talked about Albemarle. Albemarle, any given year, it might be, the world's first or second largest lithium miner, but it has other revenue streams to the extent that, traditionally, Albemarle derives less than 50% of its revenue from lithium. That's actually changed recently because of how well lithium prices have done. So it sort of defeats the purpose there. But in some cases, we do have some flexibility. But again, the idea at Global X is as much as possible with these thematic products. And in many cases, you will see in these portfolios, every company will have at least 50% revenue exposure. And that is a key differentiator with other, competitor products as well.
Yeah, fantastic. And I think that's a great insight actually to end on. That just leads me to say thank you very much for joining me on the podcast, Alex. It's been a real pleasure.
Sure. It was my pleasure as well, Hayden. Thank you so much.